Oh, everyone, the betrayal. Strongman personal finance. Went after my favorite fund, PIMCO PDI, and we gotta make a response about it. Now, I really do like Strongman. I respect him a lot. He's taught me how to look at financial statements and many other things. The one thing, though, me and him disagree on heavily is dividends. I look at dividends as the purest form of passive income investing. Why? Well, you shove it into a TFSA and it is 100% tax free. You can take that money out, it's still tax free. Leave it in there, it's tax free. It doesn't matter. An RRSP, on the other hand, you put it in, you get a small tax break, and then when you take it out in retirement, you get taxed on it. So I see it as an avoidable taxable event that can work out in your favor if you do research and the company can sustain it. Strongman, on the other hand, sees it as a out of your control taxable event, and everyone that pushes it 9 out of 10 times is a scammer. Adrian from Passive Income Investing, dividend bull in his opinion, Everything Money, Meet Kevin, Jeremy LaFufu, and many other people have pushed dividend stocks and have not told you, oh, by the way, you're going to get taxed on it unless it's 100% return of capital, which is me just handing back your own money. So with that said, I'm excited to get into this video, and I'm excited to go over the points he makes and give the other extreme opinion on. He hates it. I like it. Let's see what he has to say.
He is shilling it. And basically in the video, he talks about it. And at the end, he's like, oh, well, once credit markets work themselves out, blah, because he's an analyst, apparently, too, right? Yeah. I'm going to buy this ETF. That's a very interesting proposition there, Dividend Bull, because I saw some very interesting things in the prospectus. Do you even know what that is, you massive freaking clown? What? Dividend go up, stock, prospectus. So here's the ETF, the PIMCO Dynamic Income Fund, down 26% all time. Now, that's past performance, right? But look at the recent performance. During tough economic times, this ETF really struggles. And you'll see it's because they have a lot of very clownish companies that they're lending money to. But the rate hikes are absolutely crushing this ETF. Okay, the yields are going up, but the actual price of the underlying securities is going down very massively. Higher interest rates, lower bond prices. High yield bonds, a bigger drop in prices, okay? So obviously this thing doesn't make money on a capital appreciation basis. And it basically, I guess, kind of makes money on total return. I'm sure it has some kind of total return. But there's a couple big issues with this.
As Strongman has stated, total return, it must have some decent total return. Let's take a look. PIMCO in 11.02 years has given people 172.13% as of last Friday. This does not include Monday, which is when this is getting recorded. VT, on the other hand, has given 168.56% over 14.91 years. So, rounding it up, with an extra 4 years under its belt, VT cannot match PIMCO. It beats it. Your average annual return with VT is 6.85, where with PIMCO, it's 9.51. The biggest reason for that, and I can guarantee you this just by looking at the large difference here, is purely from the dividend and the fact that when it's reinvested, it compounds a lot more aggressively than without. So, Strongman, you're right. It does have decent returns, but it also outperforms your fund VT that you like to push. And I really do like VT as well. It's a total world, as you say, every single stock, every single market shoved into one. Why go anywhere else? And I agree. But PIMCO, which you are crapping on, has generated very good returns, even on par, if not slightly more than VT. So that's the total returns for you, folks. Let's go back to see what Strongman has to say.
Big issues with this fund that are insanely dangerous. Dangerous! And here's Dividend Bull. The dividend go up, the yield. And he's got a link to another video in a video. Interesting. Okay. So let's go ahead and read about this ETF. So blah blah blah, the dynamic income fund. Look at this greaseball right here. He reminds me of somebody that in college that was a total freaking loser. Actually, let's just go straight to the prospectus. So the first thing is I pull up the prospectus, right, which is like basically telling you, it gives you a bunch of disclosures and information about this fund. Summary of fund expense. I always go to the expenses first. The following table is intended to assist investors. Yeah, you think those clowns even know how to read? In understanding the fees and expenses that an investor in common shares of the fund will bear as a result of an offering. The table reflects the use of leverage in the form of reverse repo agreements in an amount equal to 43% of the total assets. Oh my, they are borrowing so much leverage, bro, to buy crappy bonds. Here are some of the expenses. A sales load, I guess this was at the offering. I don't know if they charge a load anymore, but a load is a load. A load is when you pay, let me make sure I'm sharing my screen. A load is when you pay an upfront sales charge to buy an ETF. For the privilege of buying this clownish investment, right at the beginning, you pay 1% right off the bat. You put in $100, now you have 99. Dividends. Annual expenses. Look at this. Look at this, okay? Annual expenses, management fees, 2%. Oh my God. Oh, what in oblivion is that? 2%. Oh, that is criminal. 2%. Really? What kind of freaking crack are you smoking buying this garbage? Man, you can get a low-cost ETF for like 0.03%. Why would you pay 2%? But the dividend strong, man. Passive income, retire early. Dividend boo. God, what a bunch of scammers. Interest payments on borrowed funds, 1.8%. Total annual expenses, 3.15. That is insane. 3% of your investment is getting eaten up, paying these doofuses right here.
Hey, look at my slips back here. I'm a financial. I manage a portfolio, bro. Pay me my expenses, bro. Yeah, bro.
3.15%. Paying them and paying interest. Oh my God. Oh. So let's go down a little bit more. Let's see what this fund is all about. So they have a
Now looking at that, I can't argue with it. The fund charges an insane expense ratio. I believe, criticize me all you guys want, that if something has a proven track record and has shown itself to be sustainable and over the long run generate good returns, you should be able to suck up a higher fee. That is why, for example, I believe HYLD has like a 2%. BMAX, I think, has an underlying like 2 point something percent. And stuff like that. Now, the thing is, I actually kind of like BMAX. I hate HYLD. And those are unproven, and HYLD said, oh, hey, congrats for paying us a 2% fee. We're going to cut your dividend. PIMCO, on the other hand, says 3% sustainable dividend. I think it's completely fine. Now, saying that, that's not an excuse at all. It's insane. But I just want to give my opinion on it. Moving on with what Strongman's going to say.
A leveraged bond fund that invests in a bunch of junk. Investment in the fund's common shares involves substantial risks. Among other things, the fund's ability to invest in debt instruments that are at the time of purchase rated below investment grade or unrated but determined by PIMCO to be comparable quality. Unrated debt, I'm sure that's something you really want to invest in. The fund's exposure to foreign markets and securities and currencies, and to mortgage-related and other asset-backed securities, and the fund's use of leverage. Oh my God. These investments are high yield and junk bonds. Investing on leverage in junk bonds when interest rates are going up. What could go wrong? Oh my God, this is a disaster. So we read a little bit more, and I saw something else very interesting on here, okay? Remember during the great financial crisis, there were these things called credit default swaps, where a buyer and seller could engage in a basically insurance transaction, where if you invested in debt, you could actually insure away the risk of that debt defaulting by purchasing a credit default swap. And basically, the seller gets paid a premium for the obligation of basically getting screwed over if the bond or the issuer defaults on the debt. Okay, so basically, the buyer gets reimbursed by the seller if there's a default on the debt. Those are called credit default swaps. Okay, they sound complicated, but really, it's like bond default insurance is what it is. Guess what this fund does? That's right. They actually sell, it's somewhere on here. They sell, here we go, credit default swaps. Wait, did I see it? It's somewhere on here. Anyway, I definitely read it somewhere. Trust me, bro. But anyway, they sell credit default swaps, and they do that to generate income, right? But what happens if a lot of companies start going bankrupt and all their debt goes to zero or goes to like pennies on the dollar? What do you think happens to the seller of the credit default swaps? It destroys them, okay? I think it was AIG in 2007, 2008. They were selling a bunch of credit default swaps. They're getting all this premium income. And when all those companies started defaulting, all the bonds started crashing. Guess what happened to AIG? They got bailed out, didn't they? But holy freaking crap, man. So it invested in junk. We're going to look at some of their investments in a second. A 3.15% expense ratio. Horrible performance. Okay, that's past performance. But there's a reason that it's done that. Okay, and all sorts of other disgusting, insane things. Why would you invest in this? Okay, out of all things, a leveraged junk bond fund that sells credit default swaps. And they do all sorts of crazy stuff. Like there's so much they do. I can't even comprehend the amount of crap they're engaging in. Okay, this is like insane. Let's see what else they do. They seeks to achieve utilizing blah 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 corporate debt, blah 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 blah, mortgage related, government sovereign debt, taxable muni bonds, blah 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 blah. Basically, every scammy, grifty way they can to make money, they do it. This is so bad. This is so bad. This is hot, stinking nuclear trash. Okay, how could this clown right here, Dividend Bull, talk about this on his channel? Oh, I'm interested. Once the credit market's improved, I'm really interested in buying the PDI so I can pay a 3% expense ratio and buy a leveraged bond fund that owns a bunch of junk bonds. But it's got a high yield dividend. So if we look at some of the holdings, right? Okay. They've got all this crap right here. You know, a bunch of looks like debt instruments. TBD. They don't really say what the percentages are. Corporate bonds and notes. Adder Group. Okay. Banca Monte dei Pasquini. Is that Corsair? I don't think that's Jeremy's Corsair. Credit Suisse. Oh my God. Look at this. SVP. I didn't even know that was in here. Oh my God. Carvana, there's a stellar winner right there. Gazprom, oh, I'm sure that's doing well. What else is on here? Russian Railways, man, I'm okay, they got some Fannie Mae's. Okay, that's generally safer. Blah 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 blah. Freddie Mac's. Let's see, adjustable rate mortgages. I wonder what happens when interest rates go up and those rates go up and the borrower can't pay that anymore. Bank of America Funding Trust. What is that? I don't even know what that is. What is this? Bank of America Mortgage Trust. What's inside the trust? I don't know. Bear Stearns. What? What is this? Is this a joke? Like, look at this mortgage Credit Suisse. Like, everything here is just an absolute disaster. Okay? Do not invest in this. Like, do you know what's going on? And trust me, this probably changes, Matt. They're probably buying and selling and incurring massive turnover and borrowing money. It's like, how could you possibly invest in this hot freaking trash? And how could you pump this on your fans? Oh, that's right, because dividends is all that matters. Do you see why I don't like dividends, ladies and gentlemen? Do you understand the grift that is a dividend investor? And don't worry, Joseph Carlson, I saw a tweet you made, boy. I'm coming for that butt.
Now, Strongman is correct about the holdings. Some of them are very bad, but note he's nitpicking. I like Strongman, but this is the one big criticism I have, is that he just looks at what he wants to crap on and moves on like that. I love you, Strongman, but it irritates me to no end when you do this. So, as he said, this holds Credit Suisse. F in the chat for poor Credit Suisse. They are no longer with us. And look at these yields, by the way. The yields aren't even that impressive. It's like 2.759%. But when we go to the actual percent, just to show you guys, percent of net assets, value, amount owned, maturity date. So looking at the amount owned, the value, and this, we can go down and see. So Credit Suisse is right here highlighted. Look at the okay performance, and in the pure destruction, the lower you get. 100,000 is now 80. Where was it? There were some really bad ones in here I want to show you guys. 200,000 is now 11. 1.2 million is $69,000. 211.5. It's so bad as you go down. Now that might scare you, but look at this. Percent of NAV, 0.004, 0.002, 0.01, 0.01, 0.006, 0.01, 0.24. Let's round it up. 0.25, 0.006, 0.002, 002, 005, 005. It goes on and on and on and on and on. It is so low, and only two of them are 0.1 or above. That's not bad at all. Okay, let's go down. Silicon Valley Bank. Let's see what it is. Oh my god, I went way too over. My god, there you go. Percent of assets, 0.1, 0.01, 0.02, 0.01, 0.002, 0.05, 0.16. The value lost here is massive. I'm not even mistaken. Look at this. Look at this destruction. But that is what you have to suck up when you buy these high yield funds. You have to be ready for sometimes massive destruction, like interest rates going up. And I'm here being like, I'm ready for it. I'll take it. It's going to suck. Russian Railway. Look at how minor that is down. Look at that. Look how it's not even that big of an investment. 0.004%. 0.004. That is nothing. Now, he talked about credit default swaps. Like, look at this. He talked about Freddie Mae. Look at that 10% yield, buddy. That's probably the highest they have. Freddie Mac. Ooh, baby. They're huge. Now, let's go on down. Now, Bear Stearns, he talked about, I need to really dig into that. They finally replied to, PIMCO finally replied to my email I sent out like 3 weeks ago. So I'm asking them about like the Bear Stearns and all this different stuff. BMO. They own a BMO fund, my friends. Look at that. Going down, Credit Suisse. Again, these we can go over them if you guys really want to, which we're just going to go over anyway. Look at these are a lot bigger. He should have definitely gone for this. 0.3, 0.2, 0.1, 0.3, 0.06, 02, 05, 02, 002. 0.15, 0.14, 03, 08, 0.16. Like this, you can criticize. Because this is probably like 1% plus. We have now probably gone to almost 3% of the entire fund with all the crap in this. That's now worthless, by the way. I understand it's very dangerous. You understand that with this fund. You're buying loans and bonds with the risk. If you did not know that, get out of this fund because you have no idea what you're buying. Now this is asset-backed securities. Look at this. Citigroup. I think it's this one or the next one down has Royal Bank of Canada. No, it's the next one down. Russian government bonds. I do not like that is in here. And in Ukraine government bonds. Sorry, that was my sticky key. And it again is very low. But look at this. What is this? Russian government bonds is 0.1% of the fund. Common stock. They own iHeartMedia, Caesar Entertainment, Oil B, Sierra Hamilton, utilities, and then rights. They own all this different stuff. Preferred securities, Silicon Valley Financial Group. Oh god, 0.002. Again, it's so low. It's just whatever. Vicky, 0.5. If Vicky has issues, these guys are going to get annihilated. But it just continues with that. It's just portions of this fund did awful. So they're getting reamed for that. Royal Bank. See, look at this. Look at this right here. This right here is 8.9% of the fund. BNP, Paribas Security Corp. Those go down. Like these right here, these short-term investments go down. PIMCO is like just screwed. They're losing a huge majority. Bank of America, Barclays, Bank of Nova Scotia, a Canadian bank. What? Canadian Imperial Bank, Deutsche Bank. Go down, JP Morgan, HSB Bank, Merrill Lynch, Morgan Stanley, RBC Capital Markets, and what is this exactly? Borrowing and other financial. This is reverse repurchase agreements. So this is part of the leverage Strongman is covering. And as you can see, it is 100% leverage because look at this. Look at these. They're all in the negative. This is all their leverage right here, folks. But also note, it's mostly banks. Canadian banks are the most safest investment in the world. JP Morgan, too big to fail. Merrill Lynch, pretty damn big. HSBC, Morgan Stanley, the Royal Bank of Canada. Look at this right here. Scroll all the way to the end. 1.5. This is like, dude, some of their stuff is in very good stuff. Royal Bank Capital Markets LLC. Royal Bank Barbados Trading Bank Corp. Citigroup. UBS. Dude, all their leverage is in mostly banks, and some of them being Canadian banks, which are so heavily regulated. Now, credit default swaps are right here, which is what he was criticizing. Look at how low that percentage is. The value has dropped massively. They've lost a lot of money. Rolls-Royce and everything like that, they have lost a lot of money on. And then these are interest rate swaps, which again, we go over here, they're mostly leverage again. And then we go down, and then credit default swaps on corporate issues. Look at how much they're getting reamed over this. They're getting destroyed, bro. Credit default swap on credit. Look at that. Destroyed once again. This fund is going through, as Strongman said, when interest rates go up and we get into a bad environment for bonds, like interest rate hikes, the pandemic, all that fun stuff, the fund gets destroyed, which we are clearly seeing the fund getting annihilated right now. So with that said, I looked at the financial statement, and this is what I came up to. The 2021 year end, they had a payout ratio of 125.5%. They did use ROC, return of capital. In 2022, they had a 63.91% payout ratio. On top of that, their income was way larger. Some of that can probably be from the merger, and other of that stuff can probably be from other, things. But they made enough money to pay the special dividend, thus is why it is so much bigger. Plus the merger of the funds. I agree with Strongman. Why would you want this? It's very risky. It has lots of stuff inside of it that would scare a lot of people. I, though, am very happy with PIMCO. I am up, including distributions and me selling stuff for a gain, up 12.46%. Now let's say I've faked all of this. Let's include the last dividend I had, which I owned 100 shares at the time. I am up right now 1.75. That seems very incorrect. Why does that seem so incorrect? That divided by div gain. There you go. Percent gain, there you go. 5.27% with the dividend. If we do not include the dividend, like, I didn't get paid ever from PIMCO apparently, 3.52. Now, this is all relatively new positions I've bought in, but PIMCO, Canadian Net, and Realty Income have performed by far the best. I like PIMCO. I'm fine with the risks. I understand the fund is getting annihilated right now. I am taking on that risk to hopefully see, high reward, high risk, high reward. If we continue to do horrible, this one may have to cut the dividend. I don't think it ever will have to. It's done just fine. They'll just do more ROC. But I am taking that risk because I see potential. It's down massively. It's down below the pandemic low right now. I am taking on that risk. This is for high risk, high reward people that want to throw a certain part of the portfolio into mine. And mine is a decent large chunk. I sold BMO for a gain today, Manulife for a gain, Alaris Equity Manager it was slightly down, I think. And I sold it all, shoved it into PIMCO to get another 10 shares out of it. So I'm at 60 shares right now, which brings me in passively 15.11 Canadian on on a monthly basis. I understand the risk. I'm willing to suck it up and take it, and we will see in the future if I'm wrong. I'm going to have winners, I'm going to have losers. I'm well aware of that. And PIMCO, due to it getting annihilated right now, could go both ways. It could be a massive win or it could be a massive loss. We will have to see what time's going to do to PIMCO. With that said, I hope you guys enjoyed this video of my response towards PIMCO and good old strongman personal finance. With that, I wish you all the best and nothing but green in your future. Bye!